Let's get more on the markets. We have seen a marginal move up in U.S. equity futures contracts, techs south of the border, including NVIDIA, slightly up in pre-market trading. Let's get more now from a frequent guest on BNN Bloomberg, one of our favorites, Lesley Marks, Chief Investment Officer at Mackenzie Investments. Great to see you.
Thank you, Andy.
So the American market now, broadly, the S&P 500 now back to level pegging for the year. So it's bounced pretty remarkably.
It has, and I think that certainly surprised investors. I mean, I think they understand why the market is higher today than it was on April 3rd, but I think people have been surprised by the magnitude of the move and the erasure of all of the losses year to date.
Let's have a look at a 1 year for the S&P 500, and certainly it tanked after April 2nd, so-called Liberation Day. Critics of President Trump are saying, well, we got capitulation day when he agreed to that tariff postponement with China, or postponement of the giant tariffs. Certainly investors seem happier on the trade front.
I think what investors are really happier about is looking at the fact that President Trump and the U.S. administration are willing to walk back from the very high tariffs that were announced on April 2nd on the, as you referred to it as, the so-called Liberation Day. And so I think there's a sense now that the administration will do what is best for the U.S. economy, and obviously that will have a positive impact on the global economy and therefore benefit, all stocks going forward. And that's really what investors are the most enthusiastic about. I think they went from thinking this is a completely irrational policy to saying, oh, actually, cooler heads have prevailed, and we will see some more of a normalized environment going forward.
There is speculation that the U.S. administration, in order to cut imports, is interested in the good old competitive devaluation of the currency. I mean, that's something nations did in the 1930s, for example. That would, if they are serious about that, and if they do drive down the greenback, that would hurt Canadian investors, presumably, who hold U.S. assets.
Certainly, and I think that people will start to look more at hedging policies when they haven't had to in the past. In the most recent past, for investors, they've benefited from the dominance of U.S. equities and the strength in the U.S. dollar. So they've had two things that have boosted their portfolios. Now, if you're thinking about investing in the U.S., you might want to think about hedging strategies if you're worried about weakness in the U.S. dollar. Having said that, for most Canadians, of course, their base currency is the Canadian dollar, which could also have some headwinds. So when you think about devaluing the U.S. dollar, the biggest determinants in the U.S. dollar index is not the Canadian dollar. It's certainly the euro and the Japanese yen.
Right, and I suppose the Canadian dollar could get caught up in just by association if the U.S. dollar slides.
Well, I think the issues with the Canadian dollar are more related to our own economic outlook. Currently, the economic outlook for Canada is weaker relative to the United States. Our central bank is responding to that with more dovish policy. So the expectations are that we would see further rate cuts by the Bank of Canada. But in the most recent expectations, what we've seen is the expectations for the Federal Reserve cutting interest rates are actually coming down. So when you think about the relative interest rates across the two countries, the Canadian dollar has some headwinds from here. It's had a nice bounce, though, and we've enjoyed that.
For sure, with our super low interest rates, in other words.
That's right.
We've got the banks reporting. TD kicks off on May 22nd. It's obviously tough, always tough calculating what your provisions for credit losses will be. But apart from the trade war and the tariff disruption, people are watching the housing market. I'm sorry to be Toronto-centric, but Bloomberg reporting today that Toronto home sellers are settling for big discounts on the listing price.
I saw that story, and in April, they said that prices are down about 5% year over year in Toronto, which is obviously a very important market for Canadian housing. And I think that's an important indication. You asked about, we started the segment talking about the stock market and how investors are quite optimistic and have brought stocks back up to the levels they were at the beginning of the year. But that's a very good pivot into, well, what are businesses thinking and doing and saying? And you talked about earnings coming for the Canadian Canadian banks. What we've seen so far in this earnings quarter has been, fairly decent report from Q1 earnings. We've benefited a lot from demand being pulled forward, but a general weakened outlook, and we continue to see revisions lower. And so when you think about that, that says to you, wow, stocks really shouldn't be quite at the level that they were at the start of the year, when in aggregate we expected earnings in kind of the 15% range. Now earnings expectations are more like 10%. So you've got something specific and fundamental to the Canadian banking sector, housing, for example, non-performing loans as well, the overall economic outlook. But more importantly, you have this sort of freezing that businesses still feel like the tariff situation could change any day. Remember, we're in a 90-day reprieve here. So there's going to be something that's going to happen at the end of those 90 days. Either we're going to see an extension, or we're going to see trade agreements, or we're going to see tariffs go back higher. But there's still a lot of uncertainty that investors seem to be ignoring today.
Right, uncertainty on the part of businesses, yeah.
That's right.
Lesley, thank you very much.
Thank you for having me.
Lesley Marks, Chief Investment Officer at Mackenzie Investments. Coming up, Honda delaying plans to invest in a huge electric vehicle supply chain in Ontario. That's after the break.